Now Dave, let's talk about the numbers. How does this model work from a financial viewpoint, and what do you need when you're assessing a deal or a project to make it work?
Okay, that's a great question, and I think what's really interesting is that through education and experience, some of these numbers which would have probably terrified me 2 or 3 years ago now just seem like it's the thing that we would do every single day. So we looked at the number of deals that we needed to find. About 180 rooms is our commitment in the next 12 months. And we work on a basis of in the region of 30,000 to a very maximum of £35,000 per room. And by that I mean that's the purchase price for the property and all the costs and all of the refurbishment budget. So Dan's absolutely right that we're trying to provide something which is of a high standard, but we are very mindful that we have to work within that constraint. So if you take a typical 5-bedroom property, we would be looking to pay about 150,000 completely finished. And the reason that it's set at that level is because if we then look at the amount for the deposit and the amount for the refurbishment, we're looking to secure that from an investor. Now the way we started the business was that we all put our own money in to start it off. A bit like Greg was saying about that social proof. So we've put nearly £400,000 of our own money into the business to start it off. If that's an investor's money though, we need to be able to pay them back. And so typically we're going to pay about 8% back to our investors. So we take that money that they've given us and we apply an 8% payment. I also make sure that we put all the properties onto repayment mortgages. And for some investors that might be a strange thing, but it's about a prudent way to invest for me. So it means our payments each month are higher, but it does mean that over 20 years we would have paid the properties down. That then gives us the flexibility to refinance these properties. So when I'm typically talking to an investor, and they would normally be in the range of about £50,000, that's normally the amount that works for them, so they get a return that's exciting, and it's enough money for us to buy a house and refurbish it. They're going to receive about £4,000 a year back on their money, so that's typically what they would get back. But then if I play our model forward over a period of time, we see that the debt is decreasing because we're using a repayment mortgage, and we allow a very small growth in the value of the property. So my model is based on 3% growth in property values. Now in the Birmingham area last year it was just over 7%, so it massively outstripped that. But again, I'm trying to take a very prudent approach. And what my model shows is that around about year 5.5, there's now enough equity in the property to repay the investor's money. But what we ask the investors to do is to commit for a period of 7 years. And again, that's because I want to take a prudent approach. I'd rather have the opportunity to pay an investor back early than have to go to them and say, I'm sorry, but we're going to be late. So typically that's how we work it, £30,000 per room all in, and a repayment of about 8% to our investors.
To back that up, because prudence is important, and we know to our investors it's really important, we also have 7-year agreements with our housing association, so we have contracts in place for the duration of the loan term. Now, as Dave said, we know that we'll be able to pay back sooner than that, and we'll talk to investors at that point in time to see whether they want the money back or not. But we certainly have planned on that basis, and it just gives us security all round that we know we can create the growth, we can pay the interest every year from the cash flow. We have buffers in there because we know that interest rates will go up, and on the basis that they are currently historically low, we kind of go on the average over the last 40 years, which is around 6%. So we factor in 6% before we even think about whether a deal will go forward or not, and Dave's got all the models for showing this. So there's a number of areas whereby we know we can guarantee our investors those returns are important and sustain our model long term. And as Dave's already said, paying back the investors is a great option. To delight investors is great, to kind of offer to pay back before we say is always nice, but also the growth long term in the capital value means that we can invest long term in property and help more and more people over time as well. So it's a model that we've proven with our own money, and with the prudence that Dave brings into this, we can secure investment for our investors and, let's face it, for ourselves as well, because our money is also tied up.